What's up everybody, Gen X Dividend Investor here. In this video I explain reasons why I would invest in JNJ right now, but then also will share reasons why I wouldn't, in hopes of presenting an unbiased analysis of the stock I'm long in. I mean, JNJ is my 6th largest position of the 28 I own, so it's an important company for me. And before I continue on, I'd like to ask you if you own any JNJ right now. My guess is that a lot of you will answer yes, because it's been a classic dividend stock for longer than most of us have been alive, but regardless, I'm still interested in seeing what you guys have to say. I personally have 967 shares of Johnson&Johnson, and at the time I'm filming this, it trades at $162.80 a share, leaving me with a position size worth about $157 grand. It's currently at a 3.05% dividend yield, so an estimate of my annual dividend income would be $157K times 3.05%, which equals about $4,800 a year. And we can double check that amount by looking at its dividend metrics on Seeking Alpha, where we see that it pays $1.24 of dividends per share per quarter, and so 967 shares times 124 equals $1,199 of divvies per quarter, which is $4,796 in dividends per year that they pay me. If I look at the dividends JNJ has paid me since I started my new spreadsheet tool, then sure enough we can see that last month in September they paid me $1,199 in divvies, and then going back to June they again paid me $1,199, and then in March they paid me a bit less at $1,150 because the June payout and beyond included their annual dividend hike. Going further back, we see that each quarter they kept paying me $1,150 until we get to March of 2023 when they paid me $1,092, so again following the pattern of raising their dividend once per year. If I keep going back in time until March of 2022, we see that that's when their quarterly payout was $1,025, and then down to $908 in March of 2021, and finally down to $809 in March of 2020. I've actually held JNJ for a lot longer than how long I've had this particular spreadsheet, and for the far majority of that time I was reinvesting my JNJ position back into itself, and then every so often I might add more cash to grow it even faster. If you want to see JNJ and all my other positions in my brokerage firm Fidelity, then watch a video I just released called What I Learned Living on Dividends for 4 Years, where I show you all that and a lot more. Okay, let's dive into more of JNJ's metrics to see if it looks like now is a good time to invest in it. First, we see that they have a strong 47% payout ratio, which gives me some confidence that they can easily cover and keep raising their dividend, assuming they keep performing. Remember, a company's payout ratio is a percentage of earnings that are paid out to shareholders as dividends. So like if a company's net income is $1 million and it pays out $600,000 in dividends, then its dividend payout ratio is 60%. And the higher a payout ratio goes, the more of their net income is going towards dividends, which can mean less capital available for reinvestment into the business to enable growth or to reduce debt or whatever. That means a very high payout ratio is often a warning sign. Like if its earnings decline, then the company could be forced to reduce or cut its dividend. That sort of situation is often risky, especially if the company's earnings are volatile or vulnerable to economic downturns. So if JNJ had something like a 75% or higher payout ratio, then that would definitely give me pause to invest in them. But some companies running in the 70s or maybe even 80s can be fine if they are super stable and not big growers. Utilities often have payout ratios in the 70% range, and sin stocks sometimes run even hotter than that. And then some types of companies don't even use the classic dividend payout ratio when you're analyzing them, like REITs, and feel free to watch my realty income videos if you'd like to understand why. Okay, now let's move beyond JNJ's healthy payout ratio and talk about its 5-year dividend CAGR of 5.61%, which means they've raised their dividend by over 5% per year, on average, for each of the last 5 years. That's a solid amount which has outpaced inflation, on average, which is what you'd like to see over the long term. Specifically, if I look at average inflation rates in the US per the Bureau of Labor Statistics, we see that most recently in 2024 we were at 2.4% relative to where we were 12 months ago, and in 2023 we had a 3.4% inflation rate. In 2022 we averaged 6.5%, in 2021 we were at 7%, in 2020 we were at 1.4%, and 2019 was 2.3%. So over the last 5 years, we averaged about 4.1% inflation per year, much higher than the normal 2-point-something% we've historically had, and lots of that inflation came from the pandemic spending we did. But as we saw, JNJ's dividend hikes have been averaging higher raises than inflation has actually been. And for reference, JNJ normally announces their dividend hikes in April, and I run a poll each year on my Twitter where people can guess how much they think JNJ will hike their divvy by. And this time the majority of folks guessed that they would increase it by less than 4%, and they ended up doing a 4.2% hike. Which is why my payout increased by 4.2%, going from $1,150 in March up to $1,199 afterwards. A helpful website I like to use to easily see dividend hike history is streetinsider.com. That site confirms the 4.2% hike JNJ did this year and shows how they did a 5.3% one last year, a 6.6% hike the year before that, 5% before that, 6.3% before that, and 5.6% the year before that, confirming that they've been averaging a 5.6% dividend hike per year for the last 5 years on average. And tied to that history is the fact that they've raised their dividend for over 60 consecutive years. 6 decades of dividend increases is one of the big positive reasons to consider investing in J&J, though of course just because they did that in the past doesn't mean they'll continue doing it into the future, though it's still something I value and want to see. Another aspect that should go into your decision making about investing into J&J is based on how your portfolio looks now as well as where you want it to go in the future. Like maybe your current healthcare weighting is too low, in which case investing in healthcare stocks like J&J might make more sense. Or maybe your healthcare weighting is too low, but your current J&J allocation is too high, so maybe a different healthcare stock might be more compelling. And of course, too high is a subjective term, as some people might be okay with the ticker being 25% of their portfolio, whereas someone else might not want to see any position being more than 5% of their portfolio. Now, Buffett has Apple being about 30% of Berkshire Hathaway, but that would be too much for my conservative blood. My largest position is a bit over 7% of my portfolio, but to some people that's too much. As a general rule of thumb, I've found that most experts recommend just going with a broad market ETF rather than individual stocks, but for those that do go with individual tickers, then they'd recommend a portfolio of 20 to 30 stocks, and they'd probably say to be careful if any single position was more than 5% of your portfolio. And beyond any single ticker, you also want to look at your portfolio's average weighted sector composition, and be careful if any sector you own is materially over or under what the market is at. Now, you might have reasons to do that, like if you're super bullish on a particular sector or industry, and if you're okay taking the risks of going heavy into something, but the older you are, the more I'd caution against doing that. That being said, my kids are both overweight in tech, and I'm fine with them being that way, even though it has its risks. Okay, another good question I like to ask before I invest is if something is cheap. Of course, you can always choose to just keep dollar cost averaging into stocks, and that often tends to work out over the long run, but I found that investing when something is cheap tends to be a way better way to maximize returns. Let's use fast graphs to see what it says about J&J's price, and this indicates that J&J is reasonably priced, as it's roughly equivalent to how the market has historically priced it relative to its earnings. Now, it's not uncommon for J&J to trade at more of a premium, but a big factor that has been weighing down on its price are the tons of lawsuits they face claiming that their Talc baby powder products contain asbestos, allegedly causing cancer. They've settled some cases, but I believe their overall legal exposure remains substantial, with what I'm guessing will be billions in potential liabilities. Last year, J&J attempted to resolve these liabilities through a somewhat controversial legal maneuver called the Texas two-step bankruptcy, which has faced legal challenges and scrutiny, and which contributed to negative sentiment towards them. As of last month, something like 83% of plaintiffs reportedly voted in favor of J&J's $8 billion settlement proposal to resolve all current and future ovarian cancer claims. Anyway, beyond all that, another reason J&J saw some downward pressure was after their consumer health division spun off, or separated, into a distinct company called Kenvue. They did that supposedly to focus J&J on faster-growing pharmaceutical and medical device businesses, but some investors are concerned about the implications of losing a stable and steady revenue stream from the consumer product side. I personally wish they'd kept Kenvue's business within their walls, and now I'm hoping that the pharmaceuticals and medical device businesses will continue to perform without the diversification that the consumer health division provided. Another item that is pushing down J&J's stock price has to do with the fact that some of their key revenue-producing drugs face patent cliffs. For example, its blockbuster cancer drug, Imbruvica, has faced increased competition and declining sales as patent protection nears its end. The threat of generic competitors and biosimilars could impact future revenue growth. So some investors are concerned about whether J&J can maintain its pharmaceutical dominance without suffering revenue declines from patent expirations. Another downward pressure has come from the overall market combined with its historically high interest rates we went through. I mean, when interest rates rise, the value of future cash flows, such as dividends, is discounted more heavily, leading to downward pressure on stock prices, particularly for dividend-focused stocks like J&J. Plus, J&J being a global company has exposed them to currency fluctuations, which has reduced the value of international revenues when converted back to dollars. Basically, J&J has significant international presence, and so a strong dollar can negatively impact its reported earnings. And the healthcare industry as a whole is constantly subject to regulatory scrutiny, and J&J faces potential risks related to drug pricing reforms in the US and globally. Like right now, there's a strong push to lower drug prices and implement healthcare reforms such as Medicare pricing negotiations, all of which can put pressure on J&J's pharma margins, which in turn can create some investor concern about future profitability and thus provides more downward stock pressure. Finally, as the pandemic gets further behind us, some of the demand for J&J's products have decreased and ultimately normalized, leading to a slower growth environment for certain healthcare products and services, particularly in the medical devices sector, and obviously J&J's revenue from their vaccine has fallen significantly. Yet even with all that, I still think its future looks good. They've recently spent more than $30 billion on medical tech companies, and a nice thing about acquiring those types of companies is that they don't have to deal with patent cliff issues. J&J's CEO said that when they do mergers and acquisitions, they are thinking about how their performance will improve over decades, not quarters, and I love that long-term mindset. And I think the FastGraph's estimate of a 5.74% adjusted earnings growth rate seems realistic. That amount of growth leaves ample room for ongoing dividend increases along with share buybacks, all of which paints a rosier picture for investing right now. Like, take a look at this awesome shares outstanding trend of J&J's over the last decade. Quite nice. And as you'd probably expect, J&J's stock price has been lackluster for the last 5 to 10 years. I mean, check out this total returns comparison between J&J and the S&P 500. What we see is that J&J has returned 45% between stock appreciation and dividends versus 111% for the S&P 500. Now sure, if you'd gotten to J&J decades ago, then you'd be outperforming the market, but their recent poor performance really highlights how those lawsuits can materially negatively impact things. That being said, one thing to realize is that one of the best times to start investing in a quality stock is when it's been beaten down for a bit, but you still might choose not to invest for a plethora of reasons. Like maybe you feel your cash can serve you better being somewhere else. Or maybe the lawsuits in question, or the products they sell, bother you too much ethically or morally or something, and then you gotta do what makes sense to you. I feel like J&J is still a great company, even with the poor performance in the last few years, so I choose to continue to stay long, and I'm actually debating tossing 5 to 10K more into it this year. I like how their business is strongly diversified, and new drugs of theirs regularly hit the market, and their increased focus on medical devices will probably provide ongoing tailwinds. J&J operates in over 175 countries, and that exposure to global markets allows J&J to reduce the impact of economic challenges in any single region. And of course, a big reason I like J&J is due to its solid financial trends. Like its sales revenue growth over time has been trending up, albeit somewhat slowly. And then here you can see a somewhat similar upward trend of net income over time. One logical question you might ask when you see this chart is what happened in 2017 to cause that massive dip in net income? Well, some of you may remember how they had to take a $13.6 billion charge related to the US tax overhaul. Specifically, the Tax Cut and Jobs Act required companies to pay a one-time repatriation tax on profits held overseas. So like many multinational companies, J&J had accumulated a substantial amount of profits abroad, which required them to pay taxes on those foreign earnings, leading to a large one-time charge, which is what you see in this fast graphs. Another nice trend are J&J's strong free cash flows, which helps in funding dividends, stock buybacks, and acquisitions. Take a look at J&J's free cash flow to dividends per share chart in fast graphs. The free cash flow are the green bars, which trend up nicely, and are materially higher than the purple bars, which are dividends being paid out each year, and this shows how the dividends are nicely covered with room to spare. Something else you might be wondering now is why isn't there a dip in its free cash flow chart for 2017 like there was in the net income graph? Well, their tax repatriation charge was recorded as an expense or liability on J&J's financial statements in 2017, which caused the big drop in net income for that year. However, much of that was just an accounting entry. Essentially, J&J was just recognizing the obligation to pay taxes on its foreign earnings, but the actual cash payments they made were spread out over several years. The law allowed companies to pay the repatriation tax in installments over an 8-year period, with smaller payments in the first few years and larger payments later on. Therefore, only a portion of the tax was a cash outflow in 2017, with the majority scheduled to be paid in future years. So because the bulk of the tax was not paid immediately in 2017, J&J's free cash flow, which measures actual cash inflows and outflows, wasn't significantly affected that year. And that's why the free cash flow chart for 2017 didn't show a significant drop, even though net income did. Moving on, another financial trend I like to review is how a company's net debt has trended over time. Net debt gives a clearer picture of the company's actual debt position because it shows how much debt remains after accounting for liquid assets that could be used to pay it off. A company with high total debt but a large cash reserve might have a low or even negative net debt, and you can see here that J&J's net debt is quite manageable. And that shouldn't be too surprising when you learn that J&J is one of only 2 US companies in the world that have a AAA credit rating, with the other being Microsoft. Another trend I like to review is earnings per share over time, and here we see a nice gradual trend up, though the last few years we see a drop off due to the ongoing Talc litigation and settlements, as well as due to the Kenvue spinoff amongst other things. Now you might be thinking that the spinoff was supposed to enable faster growth, but it has had a short-term negative impact on earnings by losing Kenvue's contribution, and spinoffs often have one-time charges that further hurt them, all of which dampens J&J's short-term earnings. But still, when I take everything into account, I find J&J to be a worthwhile investment right now. The litigation is my biggest concern, but I'm sure they'll get past it, and I like the growth I see in J&J's future. They continue to make strong R&D investments, both in medtech and in pharma, and they continue to have a decent pipeline of new treatments, particularly in areas like oncology, immunology, and neuroscience. Plus, J&J has shown that they have resilient businesses even in recessions. Their focus on healthcare has tended to perform well during downturns, and demand for healthcare is generally inelastic, which basically means that people continue to purchase healthcare even when prices increase, at least as much as they can. Ultimately, I see JNJ as a defensive stock and a safe haven stock, meaning that I believe it will provide stability and reliable returns in volatile markets, at least over the long run. In summary, investing in JNJ could be appealing for those seeking a reliable dividend stock with exposure to the healthcare sector, though litigation risks, mediocre growth, and potential regulatory issues might give investors pause. It all depends on your risk tolerance and investment objectives, particularly regarding income versus growth potential. So is now the right time to invest in JNJ, assuming you have cash to invest? I personally think the answer is yes, but you need to do what makes sense according to your own risk tolerances and beliefs of where you think things will go. And sure, some experts are predicting a big crash will hit us soon, unlike anything we've seen before, though the reality is that no one can consistently predict the future. Please leave me a comment telling me if you think we'll have a big crash within the next 12 months, or if you're guessing that we won't have one. It's always fun to see where the community's mindset is. Regardless of that, and even if you aren't interested in JNJ, I'd still encourage you to invest in whatever you think does make sense. Investing is the best way I know of to slowly grow your net worth, and investing in quality dividend stocks in the S&P 500 is the most motivating way I've found to do it. The vast majority of people in the US will need to invest if they want a healthy retirement. And in not investing will probably force you to have to keep working until you're in your 70s, and while you could be in the minority of people who love to work, my guess is that you're like me and you'd rather have the financial freedom to do what you want with your time, rather than be forced to clock in and deal with the stresses of a job. I just saw this article that said that serious heart attacks are more likely to occur on Sundays and Mondays, more so than any other day of the week. Understandably, there's a strong correlation between the start of the working week and the incidence of heart attacks due to the stresses some people get thinking about going back to work. The longer you work, the more stress you expose yourself to, and some stress is probably good for you, but ongoing toxic stress is something you don't want to deal with. And so try to put yourself in a position so at some point in the future you can walk away from the 9-to-5 thing because your passive dividend income is covering your bills. Most people love being able to retire early, and quality dividend stocks can be your key to helping make that happen. And please don't end up like this guy in this other article I just read, who regretted waiting until age 70 to retire. Apparently he was trying to maximize his Social Security payout. He and his wife worked for decades, and they both were super close to the retirement line when his wife unfortunately abruptly died at age 68. Looking back, he said he wished he had retired earlier with his wife, as well as maybe invested some of that Social Security that was flowing in. And while I avoid talking about politics on my channel, I'll show you something that both Republicans and Democrats agree on, which is that America faces a retirement crisis. People from both parties say that they expect to need about $2 million in retirement assets to retire comfortably, whereas the majority of people they surveyed had less than $150K saved for retirement, with 25% having no savings at all. So if you're concerned about your retirement, then know that most folks are in the same boat, but at least you're actually striving to increase your financial literacy by watching videos like mine, and there are numerous studies that demonstrate how financial literacy is linked to better financial outcomes. These studies show that individuals who have a higher level of financial literacy tend to make more informed decisions, leading to improved financial behaviors and outcomes in areas like savings, debt management, retirement planning, and wealth accumulation. So keep learning and investing, and I'm confident you'll retire quite nicely. For me, JNJ checks the boxes for the types of company that should enable my long-term retirement needs for both income and growth, even though that nothing is guaranteed. And with that, I'll ask that if you appreciated me doing this video, then please help me out by hitting that thumbs up button, subscribing if you haven't yet, and click that bell notification, as all of that really helps. Now I'd like to recommend that everyone check out my Fast Graphs affiliate link, along with my coupon code in the description of this video, as using both should allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend that you check out my Seeking Alpha affiliate link, as new users often get good discounts for signing up. Plus, take a look at my Patreon seats to see if there's any you want to sign up for, but since my Patreon, Aristocrat, and King seats are often sold out, I'll also recommend that you join my channel membership, which gives you a variety of perks you'd probably like. Finally, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.